Cash secure puts are simply having the money in your account when you trade a put to cover potential assignment, right? So the alternative would be a margin account, right, where you don't have to have the full amount. So I don't ever assume anybody has a margin account. That's just kind of a rule I go by. I don't expect people to get margin permission. So every product I ever have, for the most part, with the exception of some very advanced stuff, I'm just assuming people are going to have cash accounts and use cash accounts. It's a lot simpler that way. So you certainly don't have to, but it's easy to get permission to trade this sort of thing. The goal here with cash secured puts, just like cover calls, is consistent cash flow. And we do that by collecting option premium. All right. Again, I'll go through this. Is just very basic option stuff, just in case um, you're you buy a put, you're looking for the right to sell a stock, right? We're taking the opposite side of that by selling a put. The seller must buy the stock if they're assigned. And your key components here. This is just a common option chain. This is from E-Trade, where you have your strikes and your different expirations, and then your premium amount. So I'm sure most of you have probably seen this so far. So I'm not going to spend a lot of time here. Okay. What makes it cash secured? Again, this is what I was talking about as opposed to a margin account. You have to do at least, so if you do a one lot, that's the equivalent of in this case would be buying, if you get assigned on a short put, buying 100 shares. So you have to have enough money to at least buy 100 shares at whatever strike price you sold. So if you sell a 50 put, you need to have $5,000, right? And, it's as simple as that. You just, broker wants to make sure there's no risk to them, that if you get assigned, you have the money in your account. Right now, if you do a margin account, it might be 50%, or you might be able to use cash from other sources. I mean, it depends on your broker. Again, that stuff can get a lot more complicated and different costs and different rules, and that's broker by broker. So I just assume cash secured, and it's the easiest way. Generally, in order to keep it more capital friendly, I will focus on lower price stocks, but there's no reason you can't do this with a $500 stock, right? You're going to have a lot more uh, capital in your account in order to do it. So that's really the main drawback of cash secured, is it can be capital constraining. Okay, so now we're getting into more of the interesting stuff. Why sell cash secured puts? Well, as I mentioned at the beginning, you can generate cash flow from option premium. So I like to say cash flow rather than income. And I do use income a few times in this presentation. But to the second point here, complements income or yield focused portfolio. Yeah, so it can be good. Both cash secured puts, cover calls can be used to be help accelerate or amplify a dividend portfolio or something along those lines. But I like to use cash flow with options because it's cash flow is not P&L inclusive, right? When you say income, normally that implies you're making money, but sometimes there's going to be situations where you're selling options on something that is currently a losing trade, right? You're obviously planning on it being a winning trade at some point, but if you're getting cash from a losing trade, that's why I like to call it, because it's not really income if you're losing money, right? So I like to call it cash flow. I just think it's a little bit more accurate. Income is perfectly fine. The SEC is perfectly fine with calling premium from options as income, but I try to differentiate income meaning something that is positive. But so that's why I use cash flow here. All right. So with what we're going to talk about, assignment is optional. It's not the goal, and I highlight that because there are people out there, and again, there's nothing wrong with this. It's not the way I think about stuff. There are people out there who say, okay, well, use your cash secured puts as a way to get in a stock you like for a cheaper price. That's not how I look at it. Technically, that's true, right? But that's not the reason I think you should sell cash secured puts. I think you should do it because the options are expensive and you're taking advantage of that. It's a side benefit if you want to own the stock and you get assigned at a lower price, right? Or it may not even be a benefit if the stock keeps going down. But let's assume it's something you don't mind owning, right? I don't assume that's the goal. That can be part of the strategy. We'll talk a little bit at the end about the wheel strategy, but generally speaking, when I sell cash secured puts, I am looking at it as an option trade, not a stock trade, right? Ideally, then this is going to happen in a neutral to bullish market. If you don't want to get assigned, you don't want to take ownership of a stock, then generally neutral to bullish markets are going to be better for that. Obviously, if everything's going straight down, you're probably not going to be one of selling puts. Now, there might be times when the market is going down where there's some opportunistic times to sell puts, but generally speaking, it's not a strategy you're using in a down market. Fortunately, most markets are neutral to bullish, right? That's the vast majority of the time. All right, so let's look at an example trade. This is United Airlines. So again, this is just a very simple example, but we're looking at puts about 3 weeks out at the time when I got these prices, about a 3 week trade. And I just, for example, looking at, let's say, the stock here, it's somewhere between 90, 91, and we want to sell the 85 put, right? That trade is going for a little over $2. So what that means is that anything above 85, you make your $2, right? Roughly $2, $200 for a one lot. As it goes down, right, you have $2 worth of cushion before you start losing money. And then below that, it's just like owning the stock, right? You lose as much as if you own the stock. So you have a little bit, when you sell the put, you have that little bit of extra cushion, whatever premium you got. So an extra couple bucks of cushion. And then after that, it's basically, again, just like owning the stock. All right. So let's zoom in on this a little bit. So the max profit is always going to be your premium received. All right. Your max loss is if the stock goes to zero minus premium. But of course, you collected the premium, right? So instead of from 85 going down to zero, you would be at 83 going down to zero. But let's be realistic. Most of the stuff we're going to do, for me, all the stuff I'm going to do is not going to go to zero, right? I'm never going to sell puts in a stock I think is going to zero. And something like United Airlines is probably not even going to 50, right? Unless there's a, alien invasion or something crazy goes on, right? We don't expect a huge drop in something like United Airlines. Maybe it goes to 70 worst case scenario, or down 20%, something like that, right? So really your max loss is probably not zero. I'm sure you're not going to say, we saw really strange things in 2008, 2009, and again during the pandemic. So, I mean, there are weird things that can happen, but for the most part, those are blips that, are obviously extremely rare. So I would not expect most stocks to go to zero. There are going to be, obviously, if you're going to sell puts on a stock that's already declared bankruptcy, that's a different story. That's your own decision. Sometimes that can work out, but at some point that stock's going to zero, most likely. So that's a different story, but that's not the sort of strategy that I use personally. Once again, your break even is your strike price minus your premium. So you do have a little bit of cushion there.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.